on the call. I'm going to go ahead and share my screen out. You should be seeing a welcome screen. Great. Good morning. Good morning. Lots of you guys coming into the queue. Good morning. Everyone on this call is currently on listen only mode, which means that our best mode of communication during this webinar is going to be via chat. So if you can hear me and you can hear my voice, if you would not mind going ahead and jumping in the chat box and giving me a big good morning, that would be awesome. Just let me know you can hear me and that you're here. Awesome. Good morning, Dustin. Thank you. Hey, Dave. Good morning. Great. You guys can hear me good out there? Awesome. Hey, good morning, Pat. Great. Awesome. All right. So I'm going to switch my screen back to, there we go. And y'all, I apologize in advance where I'm having a little bit of technical difficulty with promoting my screen, but I'll try to streamline that as much as possible during the beginning of this webinar so that we can have it all worked out by the end. Just gonna get my screen going, but good morning. Thank you guys for putting that in the chat that you can hear me. We're gonna have a great webinar this morning. Really excited about talking about exit planning and succession planning. Many of you all are in the throes of business, and this has been brought to our attention multiple times that this is certainly an area that we want to bring attention to. So super excited to have you guys on this morning. All right, we're going to give it a few minutes, and we got lots of people still getting into the queue here. Good morning, everyone. Make my screen nice and big here so everybody can see. There we go. If you are on a tablet or a mobile device, you should be able to see on the bottom right hand of your corner, you'll see a heart icon. That is one of our favorite friends on our Atlas webinars. It's actually really cool to get hearts. So if something resonates with you that Joe and Kevin say today, then feel free to give some hearts. There you go. And awesome. That just lets us know that you're engaged and you like what you hear. And we'll also have a lot of interactivity as we always do on our webinars. So really excited to talk about exit planning and succession planning. We're going to give it about 1 minute and we will be getting started. Good morning. Good morning, everyone who's joining us on the call, and welcome to the Atlas Pro Plus webinar on exit planning. So glad you all were able to jump on. You should be seeing my screen right now with the big red welcome sign. Special thanks to our partners for this webinar, Beacon Exit Planning and Succession Planning. You'll meet them and talk to Joe and Kevin here shortly. And special thanks also to Roofing Magazine, who has helped to spread the word about this webinar. So thank you to all of our partners. And good morning to you all. Great, I see lots of good mornings coming in, so thank you. If you're just joining us and you can hear me, you are on listen only mode, which means that the best mode of communication during this webinar is going to be via chat. So if you can hear me well, or if you have any questions during the webinar, we always love to get questions and make it interactive and have lots of feedback. So feel free to pop any questions you may have in to the chat box. And for you that's just joining us, go ahead and give me a good morning so I can shout you out. And really, really looking forward to a great webinar today. Awesome. Great, great, great. Okay, well, without further ado, we're going to get started. Today's agenda, we're talking about exit planning. We have special guests here today, but let me just give you a lay of the land here. As I stated before, you are in listen-only mode. However, if you have any questions during today's webinar, feel free to put those into the chat box. We want to hear from you. We want to hear what your questions are, and we will be answering those live on today's call. So feel free to put any questions that you may have into the chat box, and we'll be more than happy to answer those. Today we're going to talk about the overview of exit planning. We'll talk about the pitfalls to a successful exit and some of the obstacles confronted by sellers as well as buyers. We'll do a quick case study, and then we'll also be available to answer any questions that you may have. As I stated before, feel free to put any questions into the chat box. Super excited today to have Kevin and Joe on the call. Kevin and Joe, as you can see here, have over 70 years of experience within this industry. Kevin, I believe, was a contractor prior to starting Beacon Exit Planning, and so he's been in our shoes. He knows you know, all of the hard work that goes, blood, sweat, and tears that goes into building a brand and building a business. And so I'm sure Kevin will give a little bit of his background as we get started, but let me just read a little bit so that you guys are familiar. Kevin is the founder and CEO of Beacon Exit Planning, America's exit planner, and Beacon Mergers and Acquisitions. Mr. Kennedy is a nationally recognized speaker, author, and thought leader for business owners with exit planning and succession. He's personally walked the exit path and understands firsthand the challenge as an owner faces exiting their business and implementing succession planning. He's bought and sold a company by finally transferring to the fourth generation management team. The company grew from 35 to over 200 employees into an ENR top 20 specialty contractor that has been in business for over 70 years. So lots of experience there. And with Joe, Joe is the COO of Beacon Exit Planning and Beacon Mergers and Acquisitions, a certified public accountant, certified value analyst, and a certified business exit consultant with over 20 years of experience in public accounting, valuation and exit strategy services to closely held companies ranging from 5 to over 300 million. Mr. Bazzano is an award-winning consultant and national speaker to business owners on exit planning, valuation, taxes, and asset promotion. His areas of expertise include financial reporting, consulting, business valuations, mergers, and acquisitions, exit strategies, tax plannings, and compliance for individuals and business entities. So, whoa, lots of experience, and we're so excited, Kevin and Joe, to have you guys on the call today. Just to give a quick shout out, Kevin and Joe, they just recently launched a new book, The Contractor's 60-Minute Exit Plan. The book is, I believe, was just released within the last couple of months, right, guys?
Last couple of weeks.
Well, last couple of weeks, and it's already #1 best-selling on Amazon. So as we know, and as Roofing Magazine knows, this is certainly a topic of interest for our contractor audience. And so without further ado, I will turn it over to Joe and Kevin. And thank you guys so much. Excited to have you guys on.
And thank you for having us. This is Kevin, and we're certainly honored to be here speaking to, in my situation, fellow comrades in this business. I just want to add one footnote. The book is in Amazon has a thing called pre-launch. The book will be officially published in September, And the pre-launch is a way of getting the book out there to our tribe, so to speak. And to our surprise, it catapulted to #1. And our highest expectation, we thought it'd be lucky to be in the top 10. So that's great news for this subject, and we're very grateful and thankful to our supporters out there. #2, 10 years ago, I was in your shoes, and I used to have a pattern of sleeping, and it went like this. During the week, after a 60-hour week and 12-hour days, I didn't have any problem going to sleep at night and waking up usually around 5 and being at the desk and in the office by 6 o'clock in the morning. The day that I always had time or always had a problem sleeping was Sunday nights. I would go to sleep without a problem like I usually did, and at about 3 o'clock in the morning, I'd be waking up and I would have 4 or 5 things on my mind, and I could never get back to sleep again. So if you're on this call on a Monday morning, my hat's off to you. You must have a system and an organization within your company that is allowing you to perform and be here listening to this, and we're honored to have you here. Before I launch on to the main part, I want you to remember this, and if you can, write it down. And it's not in your slides. There are 3 gorillas in the room when you're thinking about exit planning. And I wasn't that all familiar with them when I started my process of buying and selling a company. And those 3 gorillas are taxes. You just can't be prepared for them. And you'll hear my story, and you'll know why you don't know what you don't know. And Joe's presentation will really dive into those. The second thing is succession. And exit planning is about the taxes. Succession is about people. In other words, getting your existing management team into a championship team, moving them into leadership, and you being able to leave the business. It simply goes like this. If you don't have anyone to sell to, you can't sell your business. And the most likely person to sell to in construction are going to be your key managers or family. It's your job to get them ready to take the baton. And the third thing is there's a lot of emotion in this thing called exiting. And the emotion is, what am I going to do after I retire? We're so engaged in our businesses as owners that it's not just what we do, it's who we are. And you need, as you figure out in the exit, how much, if you can afford to retire, your next thing will be not just getting the next team ready for succession and taking over the company, but it's going to be, what am I going to do? And what you're listening to right now is what I decided to do when I exited the company. I knew it was so tough, and so did a lot of my competitors. They asked me to help them out with exit planning and succession. And that's what I knew I could do to really benefit and to see my future. And that was being involved in this subject that I am now, I live every day. So the thing in construction is the most likely exit is going to be selling to your families and managers, and we're on the slide right now. And your challenge will be is how you're going to capture that trapped wealth, illiquid wealth, trapped in your business, and to be able to retire and not run out of money. And that's kind of what we're going to be talking about right now. Slide. There's only one guarantee, and you already know what it is that you will exit. You will leave your business. But you, as the strategic owner, you're either going to do that voluntarily or involuntarily. And what you may not know right now, and that I didn't know, is the odds are really stacked against you selling or transferring your business. Slide. SBA, Small Business Administration, just did a recent study, and it kind of reflects what you're going to be facing. It says that at any given time, 40% of the U.S. businesses are facing a transfer ownership issue. And that's really become large because of the baby boomers owning the businesses and trying to figure out how they're going to exit. But the primary cause of failure is lack of planning. And if you look at your own business, you're going to figure out, you already know intuitively, that if you don't plan, you're just asking for problems. Your challenge, and what you probably don't know, and maybe you don't realize, but we as owners are constantly reinvesting in our business in order to grow it. And the statistic of 75% may surprise you, is that 75% of typical business owners' net worth is tied up in their illiquid business. And only 22% of owners have done any succession planning or exit planning. Slide. These three statistics are something that you actually need to concentrate on in this presentation. Write down these numbers if you're not going to get a copy of the slides. 70%, 30%, and over 55%. 70%. More than 70% of your wealth is trapped inside your illiquid business. And your challenge is how you're going to cash out without being clobbered by taxes, retire, and not outlive your money. That simply is exit planning. 30%. Fewer than 30% of private businesses will ever sell or transfer. Most of them settling in liquidation, or about 10% of your business value. I imagine most of you have already seen successful owners fumble the ball in the red zone of their career and have to liquidate. I saw it all the time when I was in the business. And if you're fortunate enough, 55%, and if you're fortunate enough to retire, guess who's waiting there for their fair share? You're right, Uncle Sam. And he can capture from 0% to over 60% of your harvest. So those statistics are really, really critical for you to understand. And all those statistics, of course, reflect a risk that you have in your exit. And you have to manage those risks, just like you manage risks every day in your company, and safety, financial risk, contract risk, all sorts of risks you have. You have to manage those risks. Problem is you haven't faced it yet. And that's what we're here today to help you with. Slide, please. If you talk to an owner and you ask them what they're going to do with their business, most of them intuitively say, I'm going to sell my business to a consolidator or a competitor. Well, guess what? That's not very common in construction because there are not a lot of outside buyers. You really have to be a larger company in a special niche and circumstance, and of course, in this kind of economic cycle, to be even attractive to do that. Slide. According to a study by the Chamber of Commerce, and this is just not in the roofing business or just the contracting business, but in all businesses, those businesses that actually go out to sell, in other words, they're approached by a broker or a consolidator or an M&A person, those that actually go to market and actually go to sale, fewer than 20% of those will ever sell. And in the construction business, that's probably closer to 10%. Slide. I will sell to my business, to my employees, managers, or family. Well, this is where the most likely exit or sale is going to happen in the construction business. You're going to sell to your trusted employees. You're going to sell to your managers and family. There's a couple of different reasons for that. Number one, that's the reality of only who you can sell to. But also number two, if you're in a construction business, you're in a team sport. And so the owners have a certain respect and affection to their managers because they're the ones who make them successful. And so the likely exit is many of them feel that if they're going to sell, they trust their managers and their employees, and they prepare them to basically be the next owner of the company. Slide. Now, some of you who saw this movie is pretty hilarious, but we call this particular most common method of exiting the Dumb and Dumber method. And if you probably go out to your accountant or attorney or some other advisor, they probably will suggest you using this slide. The way it's set up is you have a son or a daughter in the business, or a good manager, professional manager, and you're going to buy the company out over 10 years. And the reason you buy it out over 10 years is that's the only way the company can afford to buy it. They can't afford to pay you they can't afford to pay you right away, or even over 3 to 5 years. 10 years is usually the common buyout. This happens to be an S corporation. If you're a C corporation, this situation, the tax ramifications would actually even be worse than our example. And the example we're going to give you is a $4 million transfer. In other words, the company is going to sell for $4 million. And what they simply do in this is their advisors tell them, well, in order to sell the company, the easiest way to do it is to gross up the salary of your managers and pay the taxes on those. And then what we'll do is they'll take that net money after taxes, and we'll buy the stock from the owner. So in other words, they're going to pay for this whole exit with W-2 income. Slide. So let's look how it works. And just for the example of this, we're going to take this out and break it down in increments of $1 million, $1 million in a sale. And of course, at the end, we'll multiply it times 4 to show you the net proceeds of this. So imagine this. If this is going to go through the company in payroll, the son has to earn $1.72 million in order to give the owner $1 million. That's based on state and federal taxes. And we don't even include payroll taxes in this. Then the dad, or the owner, finally gets $1 million. And what happens immediately after that? The father then pays capital gains, and which is going to be 20 plus almost 4%. So there's and state tax, and we're using a 5% example, and that's almost 28%. So in order for dad or the owner to get $1 million, they got to pay $712,000 in taxes and fees. So a $4 million deal looks like $2.8 million in taxes. Let's break it down another way. Slide. So in order for dad to get $4 million, $6.8 million has to go through payroll. Dad banks $2.8 million of that. In other words, what that looks like is Uncle Sam gets 60% and dad gets 40%. It's pretty crazy, isn't it? Slide. There's a question coming up. Do I read this question? I will.
Yeah.
What is the range of potential tax obligation that can be incurred during in a sales transaction?
Awesome. So this is
something on board.
And we're going to launch the poll now. So go ahead and enter your answers. We have people voting, 10 to 20%, 20 to 30%, or 0 to 50. Awesome. And it looks like the votes are coming in. Great, and we will close the poll now. And so it looks like most people said 0 to 50. Kevin?
Well, they're right. The potential for taxes are over 60%. And that's, of course, if you live in a state like California where you have a 13% state tax. But there are ways actually to get 0% taxes, and there are also ways of reducing those taxes, and that's what Joe's going to talk about. So even if you put 20 or 30%, maybe you're shrewd enough to know that you know some methods of eliminating those tax obligations. Slide, please. So today, our role as teachers is to help you understand how to beat those odds. And we're going to show you some systems and some techniques in Joe's presentation that will lay down the most likely exits and really help you so you can capture your hard-earned business wealth for your spouse, for your family, retire gracefully, and pass the baton to the next generation. Let me talk about my exit and my situation. Slide. We had, I would say, good advice, not great advice, when we exited our company. And let me go a little bit into my situation. I came to the company in 1980. Dick offered myself and 3 others an opportunity to buy into the company because he was planning to retire in 10 years. And we started transferring stock at when I was in 1987, and we finally owned the company in 1995. And then we started moving forward. And what I found out when we went to sell our company, we just to put in perspective, around 1995, a lot of us were. It was, if you remember, any of you were old enough to remember back then, it was a booming economy with the tech boom. And we had all sorts of consolidators approaching us, brokers and everybody else to sell our business. We looked at that and we looked at all sorts of opportunities, but we finally ended up deciding that we wanted to sell to our employees, which is the path we went. And this is what happened. So I retired and I've created Beacon Exit Planning and Succession and went back to school for 2 years to get certified in exit planning because I realized I needed that technical ability to go out and help other owners. And it was then that I discovered that our Ivy League advisors of over 30 years, cookie cutter advice, cost us millions and millions of unnecessary taxes. Millions that could have been saved with what I know now. And unfortunately, this happens all the time. That was kind of my genesis moment to take this information about exit planning to other owners and take it on the road and speak at conventions. Because I found out the hard way that you don't know what you don't know. Slide. So the cost of not planning, you lose control of so many aspects of your business. Retirement, succession, the value of your business, overpaying income and capital gain tax, and overpaying estate tax if you are going to have a estate of over 10 if you're single, and over 20 if you're married. Slide. So you get the message. You don't know what you don't know, and we figure this out all the time. We learn by our mistakes. Unfortunately, this was a very, very expensive mistake. It happened to be my largest financial event of my life and my business partners, and we paid for it. So the whole idea of today's presentation is to help you understand how this can save you millions. Slide. Slide. So we're in the construction business, contracting business. Let me prepare you for Joe's presentation. And the best analogy I can use to help you understand what exit planning is the analogy of what an architect does in the business. Now, an architect, when he's designing what he does, he deals with lots of different disciplines of a building and building a building. And their responsibility is to create clarity for you to build that building as a contractor. So the architect designs a specification and drawings to define the requirements, and what he does is, or he or she does, is coordinate that entire process. Coordinate that entire process so you, as the subcontractor, understand exactly the requirements to not only build to a specification, but also to coordinate your trade with other trades. Well, we as exit planners are also designers and process consultants. What we do is in a similar fashion, we as exit planners take a kind of a holistic approach to pull all the moving parts and disciplines together in an exit specifically based on the owner's goals. So we can demonstrate several paths, options, and most importantly, a bottom line after-tax result so the owner will not outlive their money. And we coordinate all these different disciplines into a comprehensive and plan that puts the owner in control. And that's critical. It puts the owner in control because they understand before they go to advisors with the plan that they have from the exit plan, how this is going to look as they move into their future, and then deal with their various advisors to clarify certain options and to do the final blueprint. My exit was different. In my exit, I met separately with several advisors that included accountants, business valuators, attorneys, insurance advisors, financial advisors, estate planners, all with different towers, and what you need to know, all with different messages in an uncoordinated way. And that's what cost us, my partners and myself, millions of unnecessary taxes. I hope that helps you, give you some clarity as we move into Joe's presentation, and I hand it over to Joe. Next slide, please. Next slide. Question.
All right, so the next poll question is, who will help me coordinate the exit planning process? So who is that key person on your team that's going to help you coordinate your planning process? Lots of people voting. So if you haven't put in your vote, go ahead and get it in. We're about 25% there. Awesome. All right, almost there. About 40, half of you have voted. If you have not voted, go ahead and put in your answer. Who will help you? Who's your key person to help you coordinate this exit planning process in your mind? Okay, and we're going to close the poll and share those results. So, guys, over 50% say that they're going to rely on exit planner.
And if I could add a little clarity to this too, I think all those people are important. Okay. Certainly your spouse, a business partner, an attorney, but your key planner in terms of approaching this in an academic way and coordinating everything would be the exit planner. But you also, as I can repeat what I said before, there are a lot of people that are advisors in this, but the only person to put it all together is the exit planner, because you'll be dealing in this with your accountant, your attorney, your business valuator, you got the evaluation, insurance people, financial planners, and estate planners. They're all the different folks will be involved, and that's who the exit planner. That's what the exit planner does. He has actually ability and training in all those arenas.
Sure.
Slide. Joe?
Okay. Well, good morning, everyone. It's my turn, and in this part of the presentation, what I'd like to really do for everybody is give you an indication of the a little bit more of the technical aspect of how your plan should evolve, some things that you need to consider when putting together your plan, but also trying to identify some, from our history, some of the pitfalls that we've seen that either could have created or actually did create some catastrophic consequences for the seller and their family as they approach the exit process. So slide, please. The first thing that we need to all understand during this process, particularly for internal transfers, is the company pays for everything. Essentially, the company is the goose that lays the golden eggs. It provides for our benefits, our financial benefit, our family's benefits, our employees' benefits, and for some particular situations, our community can benefit from our company. So it's important that we create a structure before we get to the exit that helps protect the business or this goose, if you will. Slide. Over our experiences, we found a couple of pitfalls that we've seen that really created some issues in helping the business owner succeed in their exit plan. The first pitfall that we identified is tax planning. Everyone meets with their accounts at the end of the year to try to identify and mitigate as much of the annual tax obligation as they can. It's just a normal course of business. For many, have for many, the estate tax has been a situation that needs to be considered. Although no, with the new tax law changes, that has not been such a concern for most now, because the estate tax exemption has been bumped to 11.2 million per individual. So for many, that's taken them out of the estate tax situation. Um, but one area that we see is that there's no tax planning being done on the exit plan side, and with tax rates being as high, or excuse me, I should say the effective tax rate being as high as 55 to 60%, you would think that there would be more proactive planning in this arena being done. You'd hate to sit there, get to the point where you exit your business, monetize your business, and then realize when you file your tax return that 60% of it is going to go to the government. That's probably not going to bode well for you in retirement. So that's one area that needs to be considered. The second pitfall is improperly documented buy-sell agreements. I will also include in this particular category improperly documented and owned life insurance policies. Although those two are completely separate, many times they are integrated, and oftentimes not too properly integrated. We've seen situations where life insurance by itself is a non-taxable benefit, but because it's improperly owned or an improper beneficiary designation, that death benefit has now been made taxable. So it really needs to be properly coordinated and make sure that it's being used in the most effective way. Litigation and asset protection. As business owners, we become target to a lot of people out there. With the advent of the cell phones, accidents happen. Litigation is now a $200 billion a year industry in the United States, and as business owners, you become targets. Asset protection is the purposeful structuring of your business in order to help mitigate the probability of being sued, or if you do get sued, help a quicker settlement. I think many of you do asset protection, maybe unbeknownst to you, but the asset protection in the simplest form is if you own a business, you put your business in one particular entity. If you own the building that houses that business, you typically set it up in a separate LLC or another form of entity. That is asset protection. You've isolated the liabilities in the two separate entities, which helps mitigate overall claims to those assets. Next pitfall that we often come across is an owner's unrealistic expectation of the value of his business. I think the reality is that sometimes because business owners work 60, 70 hours a week in their business for 20, 30 years, they feel that they're creating value, when in actuality it could be detracting value from the business. So in this particular case, it really makes sense to have valuation of your business, understand what creates value, what detracts value, so that when you get to a point where you want to start monetizing your business, you can have some semblance of realization as to what you could expect on the sale of your business. The next pitfall is the lack of succession planning. As Kevin alluded to earlier, exit planning is the monetizing of your business or the replacing of your income. Succession planning is the replacing of yourself and training your employees, your managers, to become leaders and eventual owners of the business. This is critical because succession planning often takes from 3 to 10 years to effectuate over the course of the process. And just as important, succession planning or the development of these individuals, you're going to be dependent on those individuals because they're the ones that are going to be cutting you a check every month. So it's important that you have the right management team, have them properly trained so that they can perform as not only leaders but as owners. Next slide. So when we talk about exit methods, there's typically 5 basic methods that you'll go through or you can utilize to exit. You can sell the business outright to an individual or a competitor or maybe a strategic buyer. You can sell to a private equity group. They're more investors. They typically look at your business as an investment with the intent of buying it, growing it, and then monetizing it for 5 or 6 years down the road. Those two are called external transfers because you're selling it to an outside party. The next three are considered internal transfers, and those would be employee stock ownership plans. That's where your benefits, your employees receive the benefit of the value of the business. It's essentially another retirement plan that, by its inherent nature, is just very, very tax efficient. But there are pros and cons to this, as there are with everyone. The fourth one is a management buyout. This is typically the most used method or strategy in construction industry. Construction, just by their nature, are very hard to sell to outside buyers unless you've got a specific niche or you've got some quality characteristics that are appealing to a buyer. Number 5 is gifting programs. I don't talk too much about gifting in these presentations because exit planning, as we said before, is the monetizing of your business. Gifting is not a monetizing strategy, but is a method where you can transfer wealth to your family members, typically your family members, in a more tax efficient way by using certain strategies as discounting and so forth. So those are the 5 major areas of transitioning a business. They each have their pros and cons. Some are more tax efficient than others, but some have greater benefits than just the tax ramifications. So in our plans, we always identify the goals, and sometimes, believe it or not, taxes are not the main concern, which is a good thing. All right, so everybody's got their own goals and their own requirements, and as exit planners, we try to consider that in all our planning. Next strategy. Next slide, please. So when we take these these 5 different exit methods and we categorize them into 2. One of the main characteristics of these 2 types of transfers is with an internal transfer, you can typically sell all or a portion of your interest and still maintain control. You can still continue to take a salary, receive some benefits, and get out a payout over time. With an external transfer, typically you're going to lose control. A strategic buyer, an investor in your company is going to want control of that business, and therefore you would essentially become an employee. So those are some things to consider based on the transfers that you're going to choose. Next slide. I think we have another question.
Yep. So the next poll question is, which exit method allows for a partial sale and continue to work and receive benefits in the salary? Is it the sale of sale to a private or equity group, outside sale to a strategic buyer, or a management boycott? So we're going to launch this poll.
That should actually be a management buyout. I think there's a little typo there.
Uh-oh.
Yeah, that's okay. It's a management buyout.
Awesome, and everyone is voting. Great, lots of responses coming in here. If you haven't voted, go ahead and cast your vote for which exit method allows for a partial sale and continue to work and receive benefits and salary. Okay, and we're going to launch that. So, Joe, it looks like about 85% said management buyout.
That's good. This is somewhat of a trick question. If you sell to a private equity group, typically you're going to sell a controlling interest, but you'll retain your position somewhat as an employee. You'll probably get some salary. The biggest thing is that you lose control. But for the most part, the management buyout is going to give you all those benefits. Next slide, please. So when we look at seller's perspective, there's 5 obstacles that typically they're going to be confronted with. Okay? One is the coordination of the various planning disciplines, the financial security, the fear of outliving their money. We're going to talk about those. The emotional attachment to the business, what the business value is, and then again, the taxes. Next slide, please. And then from a buyer's perspective, there's obviously somebody else sitting at the other end of the table, And so they're going to have some issues and some considerations that they need to address as we get through this. Um, and the biggest question that always comes up is, from a manager's perspective, how can you buy in? How can I afford to buy in? Um, Typically managers are making a modest salary. They have kids in school. They got all kinds of things going on, and haven't been able to save enough to buy a $3 or $4 or $5 million or whatever business or whatever the price may be. And so the exit plan has to really identify and deal with these kinds of issues. Even more so, once you buy the business, there's a business continuation process. Banking, bonding, line of credit concerns, those are all going to be issues that need to be addressed too, because the last thing you want to do is buy this business and then your bonding company or your bank reduces your credit facilities, and you've essentially just reduced the value of your business because you can't conduct the same level of business. These are issues that need to be considered. Taxes. Buyers also going to have some tax ramifications. What are those tax ramifications? What are the overall costs of buying this business for the buyer? And then there's more of the succession planning issue, the ownership versus employees. Thinking as an owner versus the employee is going to be a big change for some of these managers. And once they realize what's in store for them, we've had situations where the managers thought that they really wanted ownership. When once they got to realize the true meaning of an owner, I think that that thought kind of passed their mind, and they realized, I think I want to stay as a manager. It happens all the time. So let's go to the next slide. Right. So when we look at our financial planning or our exit planning and dealing with our customers and our clients, we always focus on three main areas of business owners planning. The one area is the business, okay, understanding the valuation, succession taxes, various transfer options, and litigation. The second sphere is the kind of the touchy-feely part. That's the emotional ties to the business. If there's family members, there's typically always a second layer of concern, or I'll say drama, that typically runs into the planning process that needs to be considered. There's a legacy factor that the business owner wants to maintain. And then the financial side, again, is the fear about living their money, but also protection for the spouse and family and the business should there be some sort of catastrophic event that befalls upon the seller. Also on the personal financial planning side is asset insulation and tax ramifications. Now what we found is that, again, much of this planning is already being done by the business owner and their advisors. Next slide, please. The big area of concern is that a lot of times you have different advisors doing different aspects of the planning, and what we find is that these spheres are not properly coordinated. And again, if it's not properly coordinated, if the arrows aren't all pointing in the right direction, there could be some unintended consequences should something befall upon the business owner or the business. So proper coordination of these spheres certainly increases the odds of success. Next slide, please. This is probably one of the biggest concerns for business owners in trying to get through the exit planning process. It's the fear about living their money. When we do our planning, we always try to identify how dependent is the business owner with respect to this business. In other words, how much have they saved outside of the business, and how much are they going to need the monetizing of this business to be able to support their post-exit lifestyle.
Sorry about that.
Okay, there we go. That's all right. So financial planning becomes a real big concern in this process, particularly since everybody's living longer. Healthcare costs are getting to be more expensive, and this is a real concern. Next slide, please. Click it one more time. So the emotional side of this business ownership. I always say it doesn't really matter if you've been involved with someone or something for 20, 30, or 40 years. I don't care who you are, but there's going to be an emotional attachment to that person or thing. And the business is no different. Essentially, we become, it's not what we do, but it's who we are. It was an interesting article last week that I picked up. I don't know if any of you guys know Kate Spade, but she's a fashion designer who did a lot of handbags. she recently committed suicide, and what they've determined was that a lot of the suicide was the byproduct of her being depressed, and they think that their depression was caused by her leaving the business and having lost something very important in her life. There's actually a couple of other cases out there as well, but again, maybe that's the extreme. But when you leave your business, it's going to be an emotional process, and it's something that really needs to be considered in the planning. Next slide, please. Next part is valuation. Okay, understand one thing: when you're preparing a valuation for a company, the ultimate value of the company is really what somebody's willing to pay. Okay, so I could sit there and put together a value for you, or put a nice report with all kinds of numbers, but if you haven't created a business that's valuable to somebody, it's really not worth much. So this particular formula will help you create a valuable business. And what this formula is really stating is that the value of the company is equal to its company's cash flow that is both sustainable and transferable times some sort of market multiple plus or minus any balance sheet adjustments. What does that mean? Well, when I buy a business, or when somebody buys a business, what are they buying? They're buying the excess cash flow of that business. Right? So they're going to make an investment in that business, and they want to make sure that that business is going to generate enough excess cash to provide me with some sort of a return on my investment. Now, in order to do that, we have to make sure that that cash flow is going to be sustainable, meaning that if the seller walks away, can they continue to generate the same amount of cash flow in the future? And to that point, is it transferable? Again, if someone walks away, if the seller walks away, can it be transferred to me? Now, there's a risk associated with that. And the risk is essentially what the market multiple determines. Market multiple is a factor of some form of a risk. How much risk is the buyer willing to take on, and what is the rate of return that they're willing to accept in order to invest in your business? Now, that's a technical aspect of doing evaluation. But I think you need to understand the basic premise here is that you've got to create a business that kicks off excess cash flow, and that is both sustainable, meaning it's not a one project deal. It's going to be a company that generates cash flow into the future, and that it's going to be transferable to a potential buyer. And then balance sheet adjustments. That's really if you've got any excess kind of non-operating assets on the balance sheet. Those typically get added back on the evaluation. In other words, those are excess values. Next slide, please. I know we're running out of time, so I'm going to try to bang through this quickly as I can. Timing is also a big concern. When do you sell your business? There's an interesting trend that seems to be every 10 years, towards the latter part of the decade, we have some sort of a economic adjustment, which makes it difficult to sell businesses. So it becomes critical when you exit your business as far as a timing perspective. I'm sure you all agree, if you guys were starting to plan in 2005 or 2006, and you say, I'm going to retire in 5 years, that brought you smack dab in the middle of 2010, which is one of the worst economic recessions we've had in a while. Probably wasn't going to be a good time for you to retire. Now, again, you've got 4 decades of history here. I don't know what's going to happen in the next couple of years, but we're due for another economic adjustment. And so the thought is, what's it going to do for your exit planning timing? Just something kind of an interesting tidbit that I thought everybody would want to know. Next slide. Another question.
Awesome. So how do I grow the value of my company? 3 options here: maintain total control of the business, financial and operational processes. B, continue to work 60 to 70 hours per week in the business. Or C, create systems in the business that will provide an efficient organization, allowing you to go on vacation for more than a weekend. I know what I would vote, but let's launch this poll and see. So if everyone can populate, how do you grow control? And the third one, I apologize, we didn't have enough character spaces, but create systems that will provide for an organization to go on vacation was C. And everybody voted pretty quickly on that one. Everybody's voting pretty much C. Some people thought they should continue to work 60, 70 hours and put the sweat equity in. Kevin and Joe, what do you think?
Well, I think working 60, 70 hours per week can help grow the value of your company if you're putting your efforts in the right place. If you're working 60, 70 hours a week in the business and not on the business, I think you're going to have some difficulty there. I think if you can create a business that has systems and that the operations essentially take care of themselves, can provide for efficiency and effectiveness, you're going to have much more success. That's going on vacation is kind of funny, but it's always a benchmark. If you can go away and from your business for more than 2 weeks or 2 weeks or greater, and you're not calling in or you're not getting phone calls from the office, you've probably established a fairly nice business, and you've created a business that's self-sufficient, and that's a saleable business.
Yeah. So we got about 6 more minutes, and just to do a time check, everybody on the call, we will try to get you out of here by 11:05. We started at 10:05, so we'll get you out of here in about the next 10 minutes. All right, Joe?
Okay. And I'm just going to whiz right through these next parts. So there's 3 parties to every transaction. There's the buyer, the seller, and Uncle Sam. We've already established this. And next slide.
Joe, there's an echo in the system.
Yeah, I know. I'm just trying to fight through it.
We don't hear it on this end, guys. So I think we're good.
Okay, good. And so again, we all understand that the government can take from 0 to 60%. And my last slide, you'll see how the same company being transacted in 4 different ways can create such a substantial difference in the tax obligation that you're going to pay. Next slide. So buyers' common obstacles: how much money do I need to buy the business? Is it going to be an all-cash deal versus financing? What are the tax consequences? Overall cost of the transaction. Costs can be taxes, fees. There could be interest if that's going to be a financing arrangement. So all of these types of things need to be understood and addressed by the buyer and the seller. Next slide, please. So there's one thing to also consider: with the exception of the ESOP, every business is going to be purchased with after-tax dollars, right? So you're going to have to generate X number of dollars, pay taxes on that income, and then the net effect is going to be used to buy out buyer's assets or stock. There's a tax consequence to that. The question is, how much is the government share? In internal transfers, it's a little bit counterintuitive. You want to reduce the value of the company, whereas in an external sale, you want to increase the value of the company. Now, why would you want to do that? Obviously, if you're reducing the value of the company, you're going to need less income to be generated, and therefore it's going to be a smaller tax consequence. Now, what we always say is it's not so much what you get in the business, it's what you get to put in the bank. Right? So if you can sell your business for substantially less than you would maybe to an outside party, and have as much, if not more, in the bank, I'm sure everybody on this call would agree that you'd be just fine selling it for the lower amount. And the idea is to get the money to the business owner through some sort of a pre-funding or in a more tax-efficient way. Next slide. Buyers, again, here's mindset, owner mindset, employees versus owner mindset, understanding the financial strains. As an owner, understanding the concerns or the risks of making payroll and securing loans and bonding, and then also really who's going to be the next CEO of the business. Next slide. And again, in construction, it creates kind of a unique situation. Is the company able to support banking and bonding on its own balance sheet, or is there going to need to be personal guarantees that that the new owners are going to have to support, which creates, again, a significant problem if the banks and bonding companies aren't willing to accept or maintain the current levels. Next slide. So there's other additional considerations that need to be considered. The entity formation, how you file your tax return is going to have a significant effect on the amount of taxes you pay. There's also the deal structure. Is it going to be an asset sale versus a stock sale? Which exit method do you select? Are you going to be an ESOP, management buyout, sale to an outside party? Each one of those are going to have different tax ramifications. There's various tools that we like to use that help mitigate some of the tax obligation, and then also the tax environment itself. Is it an increasing tax environment or is it a decreasing tax environment? With the passing of the new tax law, it is going to be cheaper to get out of your business and to conduct business for the next couple of years. So the question is how much? Next slide, please.
All right, so Joe, we may want to skip this survey.
Yep. So let's do a quick case study. Next slide. Here's a typical composition of a business owner. He's got 66% of his wealth trapped in the business. He'll own some real estate and then would have saved some liquid assets on the side. Next slide. So here's how we determine their financial readiness, so their dependency on the business. So Steve and Susan estimate their annual income needs or expenses are going to be $575,000 a year. That's based off of wages of $350, but also they have benefits through the business that are usually paid with pre-tax dollars, after-tax dollars, and now they're going to have to tax affect them because they're paying it through their own personal account. And those are typical meals and travel, entertainment. There's some vehicles, maybe health insurance, different types of expenses that are deducted through the business, but now are pre-tax. So now, we have a $575,000 need. Next slide. We've identified that they have other sources of income, investment income. That should be Social Security income and some rental income that helps support some of that $575,000. So their income to be replaced is $425,000. Next slide. So we look at their income in the middle of the page. They need $425,000, and at a modest 5% rate of return, they're going to need $8.5 million in liquid assets. Now, appreciate the fact this is a snapshot in time. Doesn't consider depreciation or erosion of the principal and so forth. This is just kind of a simple calculation to make you understand how we come across the income needs. So if we have 8.5, we need 8.5. We have 1.1. We need 7.3 million. That's our income shortfall. Where's that money going to come from? So we need to get that from the monetizing of the business. Next slide. So here's a list of tools that we typically use to help us mitigate some of the risks in the business and try to minimize some of the tax consequences. Next slide. So here is a situation. Again, this is a company that we use an actual computation. One company, 4 different transactions, and understand one thing. So the first line at the top is, you'll see 13.277. That's the amount of money that the company is going to have to pay out to get the owner to the sales price. So you can see it can be as high as 13 million, as low as 7.5 million. And the net proceeds after taxes and so forth is as low as 5.9 to as high as 7.9. Now down at the bottom is the real kind of kicker. The total erosion of the proceeds was as high as 52%, as low as 5%, and then somewhere in between. So again, understand one thing, that based on the different strategy you use and the tools that you can implement, there's going to be a substantial tax savings, and there's going to be some substantial characteristics of each transaction that are going to help support your goals. Next slide. So I'll leave you with this last note. This slide says you must pay taxes, but there's no law that says you got to leave a tip. So your goal here in exit planning and exit is to help mitigate that tax and try to make Uncle Sam a minority partner in your transaction and not a majority partner. Next slide. And I guess we got, what, 3 minutes for questions?
Yeah, awesome. So, first of all, wow, what a power-packed hour. And thank you to Kevin and Joe for this information. I think it's adding so much value to set up our businesses and figure out what the next steps are for succession planning and exit planning. And as Dustin said, yeah, I echo you, Dustin. Lots of great info here. If there are any questions, we got about 2 more minutes. We're happy to throw any questions that you all may have. So go ahead and put those in the chat box if you have a question. We'll give it about 10 seconds. And if not, please take full advantage of the information here. Joe and Kevin's information is right here on the screen. And we'll also make this webinar available to you on Asphalt Life. Just simply go to atlasroofing.com/Asphalt Life. And then finally, you'll be receiving a brief survey for those of you who have attended the webinar to get your feedback. And here are other topics that you may be interested in. We do these webinars as a service to our contractor base, and so certainly we want to thank you, Joe, and thank you, Kevin, for this great information. And if there looks like there's no questions, so you guys were thorough and got a lot of information crammed in there. And feel free to, please, guys, if you're on this call and you have more questions, follow up with Joe, send Kevin an email, grab the book, because I think this is certainly a topic that we need to be talking about more, especially as entrepreneurs in the roofing industry. So thanks again, guys. And if there's nothing else, we will sign off.
Thank you.
Thank you.